Hello, my name is Peter Mothy, and I'm here to share with you Trademark Capital Management's review of the December 2024 Federal Reserve Open Market Committee meeting. Let's get right into our slides today. First of all, Chairman Powell made the point that GDP economic growth is constructively positive and steady so far. Core PCE inflation, that's the personal consumption expenditures inflation, is higher than the target, but progress is being made. Inflation appears to now be the primary concern of the Fed. Now, as of yesterday's meeting, the Federal Reserve did cut interest rates 1/4 of a point. They did make a point to say that the balance sheet reduction or quantitative tightening is going to continue. Expectations are now for only 2 more 1/4% cuts in the next 2 years, in each of the next 2 years. That's a much slower pace than what was previously expected. And that's one of the reasons why the stock market took a tumble on the news. The Fed is going to be taking Fed funds to a 3.25% to 3.5% zone by the year end 2026, which is a year later than expected after previous meetings. GDP growth is expected to be around 2% for the next 2 to 3 years. Now, mind you, this is a relatively slow growth rate for the U.S. economy. Now, looking at this graph produced by McClellan Financial Publications, this is the 2-year Treasury note yield in green. In black is the Fed funds open market rate as set by the Federal Reserve. And then the yellow shaded area is what is presumed to be today the neutral zone or neutral target for the Fed funds rate over the next few years. So as we can see today, I've drawn in an extension for the black line. I've got that in red to point out Tuesday's 1/4 point decline. The 2-year note is still trading lower than the Fed funds rate, indicating that the open market is still counting on these future cuts in the Fed funds rate. Now, if we take a look at the yield curve after yesterday's 1/4 point cut, the yield curve today is in blue. You can still see that the yield curve is inverted, meaning the short-term rates are lower than the long-term rates. The blue line is as of today. The black line is 1 year ago. So you can see, and this is an interesting situation, that even though interest rates have come down substantially at the short end of the yield curve, longer term rates have actually gone up over this period of time. Now, this is important because if the Fed funds get down to 3.5% or possibly down to 3%, notice that a typical yield curve will have a slope something like the green dashed line here. That means that the long-term end of the yield curve is not going to be coming down at the same rate as the short end of the yield curve. We will be seeing lower interest rates for money market funds and savings rates. That's at the short end of the yield curve. We'll see slightly lower bond and mortgage rates, and we will possibly see the 2% growth rate of the GDP continue over the next 2 to 3 years. There is also a potential for the dollar to remain strong simply because U.S. interest rates are going to come down much slower than we had previously anticipated. And don't forget, you can follow us on our website at trademarkcapital.com. You can follow us on X, formerly known as Twitter, YouTube, as well as on LinkedIn. If you have any suggestions for future videos, please don't hesitate to contact us and let us know.